Good evening, everyone. The time is 7:45, and a big welcome to everyone watching us this evening. Nice to have you with us. It's a little chilly in Johannesburg tonight. I'm sitting on top of my heater, and we're joined by guests from all over. Alexander Babich, welcome. Let's unmute you.
Yeah, there we go. I just wanted to keep quiet in the background. Yes, hi, Howard.
No, on our webinars, this is informal, this is casual, and we never keep quiet. And as you can see, we don't wear jackets and ties either.
Well, I've got my jeans on underneath, so it's all good.
Look, wearing pants at these times is a major bonus.
All good. Lovely to see you. Nice to chat to you, Howard. I see John T's very relaxed here, so I'll remember that for next time.
John T, tell us,
Howard,
do you have
how are you?
electricity your side of the world?
Yeah. Interestingly, I didn't realize there was load shedding. Garov, who's on a bit later, phoned me now and said that he's on the way to the office because he's simply been load shedding. He's got no power. So hopefully it stays on.
Look, I haven't had power since Friday, so it's not something I plan on getting used to.
You should pay your electricity bill.
You know something? I'm trying. They promised to reconnect me in 72 hours, but apparently you don't count hours on weekends. Leo Ati, you're in Cape Town. You don't have these problems. No one in Cape Town ever has these problems.
We are, yeah. We haven't had load shedding for a while. But have you been cut? Now, realistically, if you said 72 hours, have they really cut you off, or what happened?
Yeah, they cut me off on Friday.
Wow.
Because, as you may know, I have attempted for 11 years to change my bill out of the previous owner's name of my home into my name. And they finally did that and reversed all the billing and the payments that I'd done over 11 years and then charged me interest. And when I queried it, rather than sorting it out, because I believe now in the middle of a pandemic, in order to sort out these things, you have to go in person and stand for a day or two at the Joburg municipality office. So instead, they arrived on Friday and just disconnected me.
Right. Very nice.
Nice. I'm not the happiest person you've ever seen in your life.
Well, you look
Howard, I can relate to that, Howard. I've been trying to sort out my water bill for the last 3 years. And I actually went in a sunk a borehole. I'm totally off the grid. And they were still charging me for water. And they say I owe them 60,000 Rand. I've been also trying to sort my lot out for 3 years, but yours trumps mine.
No, I mean, it's only been 11 years trying to get a bill into my own name.
So how are you keeping the lights on, Howie?
So I actually have a inverter, which of course ran out by Saturday. I think it's a 75-meter long extension cord that goes from my study down the passage, through my bedroom, out the window, past my garage, past the domestic quarters, and plugs into the security guard hut round the corner.
God.
But
let me guess. You're the chairman of your body corporate, and you got instant approval.
Apparently so. Well, everyone else will be watching this evening in my complex, so maybe someone will go unplug the plug. So many people have wanted to pull the plug on me on the last few days anyway.
Just connect illegally to the power lines outside like half of the country does. I mean,
well, I did suggest it to them when I called them and said, well, you've told me 72 hours. What prevents me from reconnecting it? And they told me that I will never get electricity again if I did that, which may be a great incentive to actually never deal with the Johannesburg municipality again anyway. Indeed. But anyway, I'm sure some of our city councillors are busy watching this evening. I just want to tell you, you do not have a happy resident in my side of the world. But Alex, let's talk about COVID. Are you leaving your home? Because the latest numbers have just come out. And in fact, today we're at 11,093 with 297 deaths. It's about a 31% increase on figures from last week. So I hope you're not leaving your home.
Well, I'm sitting here at the office. I'm actually at the moment, but I can say it's getting real. I've had literally doctor clients of mine, surgeons, etc., literally phoning me. They're actually isolating at home with COVID. So I think everybody, if we're going to be sympathetic towards our medical people, we've got to do it. But I've actually got, this has really got more real than last time. I've literally had people that I know that have lost their lives. So yeah, it's definitely becoming, yeah, I don't even know how to describe it. Sometimes you're at a loss for words with this thing, Howard.
Yeah, and I'm at a loss from words that people still think that you can go to restaurants at this point in time, or have kids over for parties, or have bar mitzvahs or weddings. This is the time where you actually have to take a stand to save your own life and the lives of those people around you. So, Jonty, I hope you and the family are not leaving the house.
No, I've been working from home basically since March last year. I quickly realized that comfortable at home. I have a 2.5-year-old, so it's nice for him, not so much for me, to pop in and out and in and out and in and out. But yeah, happy to work at home. I think what Zoom has made everyone realize is how efficient you can be, not having to have to travel to meetings, sit in traffic, travel around the country. You can do it all from the comfort of your home. I think what COVID has done is made us all accept that it's actually fine. And yeah, from a work life perspective, a lot more family time, which is nice. But I guess being in isolation or away from people definitely has a psychological impact. And you've had a few webinars on this topic.
Well, talking about wanting to maybe not isolate from home, where else would you want to be other than in the bush? So, Jeff Miller, your surroundings behind you look like you're on safari.
Well, Howie, you're 100% right. I'm in Madluli Safari Lodge. I'm actually sitting in the curio shop. So you can maybe see some of the fittings and the merchandise around me. So this is my happy place.
So Jeff, let me tell you, it's my happy place as well. And if you look on your Wi-Fi, you'll see there's a Wi-Fi called Howard, because we broadcast a webinar from Madluli, and they've never taken away the Wi-Fi. So if your Wi-Fi signal gets a little iffy, just go click on Howard. I don't remember the code anymore, but it gave me good Wi-Fi while I was there. And the animals were spectacular. In fact, I was there while the Joburg Philharmonic played in the bush at Madluli. And while they were playing, there was sable running behind and elephants wandering behind. And it is just one of the most remarkable special places in the world.
Yeah, so I agree with you 100%. We had some visits from some elephants today, which is a nice, beautiful visit or visitors to have.
I hope while people wander past that curio shop that at least one or two people make an offer for you, Jeff.
Thank you. Happy.
Gaurav Nair, welcome.
Thank you. Thank you very much.
I see you dressed up for us.
That's right. I also came to the office as well.
But that's because you're also sitting in the dark like me.
That's right. That's exactly right. So I came with we have a generator.
Okay. And story of our lives. You need the generator. Yeah, don't you invest in power as one of your NAF investments?
I don't know. I think we should invest in Wi-Fi that goes outside of Jeff's curio shop. But over there.
I tell you what, we'll take you up on that.
but it's good to see all of you.
In fact, power and power generation is a huge issue in the country. And Jonty, a number of the 12Js actually invested in power and solar power installations in particular. But probably the announcement last week by the president that you can go up from 1 megawatt power generation to 100 megawatts has probably come a little too late for the 12J industry.
Well, I think from a fundraising perspective, probably, I think what's always important is for a 12J to be able to, promote around the potential investment opportunities, and having, much smaller opportunities prior to the announcement was less attractive. But now these are big deals, big projects, but there are a number of 12Js that have raised a lot of money. Some aren't raising any more money because, they've got too much money currently. But this will now give them opportunity for bigger investments. And I think for those investors, that's a great opportunity. But yeah, I think what we will see is a lot of institutional funds become available for these new renewable energy projects. And I think it's great for the country.
So, Gaurav, on your side, have you invested in energy at all?
No, we haven't actually invested in energy, but we've got quite a few solar PV players in our pipeline that are in the final stages of due diligence. And they're very excited by this increase to 100 megawatts. It's blown everyone's minds speaking to these guys. And also the promises that there's going to be some kind of framework to be able to wheel power across municipalities, etc. It de-risks these projects massively because you install on one roof, and as long as you've locked in the roof space for a long period of time, you don't actually need to sell to that client. You can actually sell someone across town. So yeah, the guys are very excited from what we see.
Jeff, you've got some power generation in your stable, don't you?
Yeah, so we've got two Section 12Js that focus on power. One is in commercial and industrial, and the other is in residential. And I must say they are performing extremely well. And there's a huge demand for this type of supply, because obviously Eskom's not doing any favors to the market. You don't actually have to advertise. I mean, every time there's they switch it off, people want to get onto the bandwagon. So I must say those are two wonderful 12Js to invest into.
So I see we're joined by Magnus Heystek. Magnus, welcome this evening. Lovely to have you join us. We're doing our pre-show chat. We've got, I see about 600 people busy watching us on Zoom at the moment, and many more on YouTube as well. And we broadcast on Facebook too. So we're expecting quite a large audience this evening. And one of the key things that we're talking about having our lights turned off. You must understand it's not so easy necessarily to live in South Africa at the moment. A lack of vaccines, a lack of power, and you need a 4x4 to get through some of our roads.
Indeed. Good evening, everybody. Nice to see some of the old faces, Alexander and Jeff and Jonty, and nice to meet you, Howard. Thank you very much for inviting me onto your show.
Well, thank you. Lovely to have you. I think Jonty is going to dispute that he's an old face, but he comes from the Free State and they all look like that there.
That's true. That's true. Yeah, it's going to be very interesting. Thank you very much.
Good. So we're going to go live in about 2 minutes. Leo, you look like you're getting into the comfy chair. We must just make sure that we get some light on your face over there because you're looking very, very dark with lights behind you. And we also need to clean your screen because we're busy getting light flare right across your screen as well.
I know how I'm just trying to sort out bandwidth issues, but I'll get it right. Don't worry.
Okay, cool. So Danny Kadar and Britt Landsman, let's turn on your cameras.
Hello, Howard. Good evening, everyone.
Good evening, everyone. Danny, you're on controls this evening. You're controlling everyone's videos and polls, and we've seen a lot of interest in tonight's broadcast. You think what segment of the market are interested in investing onshore, offshore, investing in 12J, but there are literally thousands of people who are very keen to hear what our panelists have to say this evening.
100%, myself included. I've been sending it out to everyone, especially in the whole tumultuous situation the world finds itself in. I think it would be a very interesting topic of discussion, onshore, offshore. No better time than now to have the discussion, especially with Section 12Js coming to an end, so to speak. So looking. So
we have to ask you: are you out of isolation yet? Because you and your wife were both COVID positive when last we checked. I wanted to drop off some cake at you, and you told me to not come clear.
We're both clear. Thank God, both asymptomatic. So which that in itself, I guess, is miraculous. We've got to be appreciative, not frustrated that we have to sit in isolation despite having no symptoms. Rather sit in isolation with no symptoms than sit in isolation with symptoms. I guess that's more inconvenient. But we're like a dog off the leash today. But obviously, just for purposes of work and getting the essential stuff done, no socializing. So free man.
free man. Well, good evening to everyone. The time has just gone 8 o'clock, and a huge welcome on behalf of the South African Juice Report to everyone watching us in South Africa and around the world. We've had enormous interest tonight in this evening's webinar. And the last few webinars that we've done have been so diverse, but attracted so much interest. So for those people who didn't watch us on Sunday evening, we did a webinar called The Great Jewish Retailers. And we had people busy telling the stories of their families. Simon Sussman came on to tell the story story of his family and Woolworths. Gareth Ackerman came on to tell the story of his family and Pick and Pay. Danny, I don't know what you're showing us at the moment, but it's got nothing of any relevance to what we're doing, other than you can go and find our webinars on our YouTube channel. So just going back to what we were saying, Philip Krawitz came to tell us the story of Cape Union Mart, and Michael Lewis joined us to tell the story of Foschini's. And it was just such an amazing webinar. We had about 11,500 people watching us live. And now, Danny, if you want to show people, if you missed that recording or you missed that live broadcast, please go on to our YouTube channel, or search for the South African Jewish Report on YouTube, and you'll be able to see that webinar as well as any one of the additional 100 webinars that we've done in the 15 months since lockdown began. So a big welcome to all of you around the world. We hope you picked up your latest copy of the South African Jewish Report. It's our June the 16th edition. The new edition comes out tomorrow night. So if you haven't seen the latest edition, get to your local Pick and Pay, your Checkers, your Dis-Chem, your Spaza shop, your garage shop, your shul, your school, and go read the latest stories. It's got this magnificent picture by Lan Ossendriver on the front cover in Soweto to celebrate Soweto Day, or Youth Day, that we celebrated on the 16th of June. And if you haven't gone to pick up your latest edition of the Jewish Report, don't forget you can always go on to www.sajr.co.za and you can get the entire edition, download the entire edition there as well from our website. And we spoke about last week's webinar. We also had a number of winners in our prize. We've given away 10 fila hoodies or track tops like this, 900 Rand each. We gave away, Danny, have you got a slide? Just in case people missed, to our last 5 winners that we gave away to patrons of the South African Jewish Report. So to Irene Bacher, to Melvin Boyskin, to Joan Joffe, to Rindani Nuvudlaudsi, I always struggle with that name, and with Philippa Kotzen, you will get your vouchers this week, and congratulations to you for winning as part of our patron campaign, for winning our last 5 sweaters from Fila South Africa. So thank you very much for doing it. Also, just a thank you to Britt and Danny, who will be on controls this evening, showing videos, bringing questions across from YouTube and from Facebook onto the Zoom platform as well. So if there's anything you want to ask any of our panelists, if you're on Zoom, don't forget there's a Q&A button at the bottom of your screen. You can ask any of our panelists any questions at all. If you're watching on Facebook or YouTube, we're monitoring the chat sections there as well. So please feel free to use those chat sections to ask any questions, and Britt will bring those questions across. So, Jonty, this evening, you are in fact the sponsor from Geltech of this evening's discussion. Tell us very briefly about Geltech. What do you guys do?
Yeah, Howie, listen, firstly, it's a pleasure and thanks for giving us the opportunity. So at Geltech, we are fundamentally alternative asset managers. So what we do as a business is we develop alternative investments. We've got various types, but Section 12J has been one of the most popular for our business, and it's been a real focal point of our business. And on the other end of the business, we're a fund administrator. So we administer private equity funds, alternative investment funds, and we do all the administration, the back office support, and we manage a significant amount of money. In the 12J environment, we have over 1.3 billion Rand. In the fund administration environment, we have over 2 billion Rand. So we're a significant player in the 12J market. We're the second largest fund manager. But something that Gaurav will attest to later is we, if not one of the best performing fund managers in the 12J environment, which we're very, very proud of. Sadly, it's coming to an end next week in terms of from an investment perspective. But fortunately for our business, we're very much sustainable in other sectors. And yeah, we're very excited to be part of today's webinar.
Well, fantastic. And thank you for sponsoring this evening. This really is the last bite of the cherry. And before we discuss 12J, I'm going to ask Gaurav and Keith and Jeff and Leo to turn off their cameras. And because before we talk about it, we're going to talk about whether you should be putting your money in South Africa or whether you should be taking it overseas. Magnus, you've made no bones about it You don't think the South African economy is doing really well. You don't think South Africa as a country is doing so well. And your suggestion might be that there may be better investments and places to put your cash than South Africa. Tell us where you've put your personal cash other than under the mattress.
Yes, thank you very much. I mean, that's an issue that's been debated for a very long time in South Africa. And at times, depending on the cycle, it's been a great place to be in South Africa. When the commodity cycle was strong, South African investors made humongous amounts of money after 2000 up to about 2008. But from about 2010, all the economic indicators started unraveling, if I can call it that. And it became quite apparent that in order to get the kind of returns that people look for, you needed to diversify and get some of your money out of the country. It was not a political statement, it was a pure financial statement. It coincided with the commodity cycle turning down very sharply 2010, 2011. But at the same time, you had the massive boom in the United States, primarily in the FANG stocks, the technology stocks, and the biotech stocks, which if you followed markets, you had to expose your own money or some of your clients' money into those markets. And the sad reality is since 2011, the JSE has become a laggard against the not only emerging markets, European markets, but most developed markets. That was until about the middle of last year when there was a small rally in commodity stocks again, but it's petering out again. So that's from a purely technical, statistical point of view, you could not sit back and say, my returns in South Africa will be adequate to keep me going, my family, my children and my grandchildren. And at the same time, you had the weakening of the currency. And a lot of South Africans almost have dollar-based life. They pay in dollars for many things, education, medical treatment, travel, etc., etc. So being a very strong proponent of taking or diversifying money out of South Africa into offshore markets, and that has been a very good call. The outcomes have been generally better than staying simply in the South African market.
Magnus, when a client comes to you and says, well, you say diversify, but what does it mean? Where do you tell them to actually put their money? Is it country related? Is it industry related? What's the sort of financial advice you give them? Ooh, Magnus, are you with us?
We have a glitch, I think, Howard.
I'm sure Magnus will join us again. So, Alexander, let's turn to you. You're not such a pessimist when it comes to the South African economy.
Well, first of all, your question, which needed to be answered, which you put to Magnus, is where does he put his money? If I heard you listen to the question, it was rather where would we put our money? Where would Magnus put his money, and where would I put my money? And the truth of the matter is, we need to put a quick bit of historical fact here. Where do I put my money? I base on the fundamentals. Am I getting value for my money? Am I overpaying for an asset, or is the asset overpriced? And you must remember that the overseas market has run on significant money printing by the American government, the British government, world banks have stimulated the global economy to unprecedented levels, to the extent that someone called it the world's greatest financial experiment. You've had trillions and trillions of dollars being printed that needed a home. Now, you make nothing overseas in a bank account. So I don't put my own money in overseas bank accounts, Howard. I don't earn any interest. I'm only going to make money on depreciation of the rand. That's the first question. I don't put my mother's money, my money, or most of my clients' money in cash unless I'm allocating it out. So that's the first question you ask, where do I put my money? And to the viewers out there, the second thing is there's only 4 real asset classes, as you know. There's equities, cash, bonds, and property. Now, if you go and put your money in bonds overseas, I did a quick analysis. Overseas, you also don't make any money in bonds. US Treasury bills are running at yields of about 0.5%. In fact, I picked up some stats here. I won't read them out because we've got limited time. But you're basically making 1 or 2% in most developed market bonds. So that's not attractive as well. In fact, you would have lost 15% in rand terms if you'd taken your money overseas at the height of the pandemic last year. You would have actually had a bloodbath. If you had taken your money over here you had panicked last year and taken your money overseas, you're actually better off in the South African market than you were locally. So many punters were, telling clients to run overseas and put their money overseas. It was probably the worst time for South African investors to take their money overseas because they've lost on currency significantly. The rand's appreciated, which I wish to quote Jan Smuts. South Africa is never as good as it should be, but never as bad as we think it is. We tend to be Afro-pessimists. We live in power shedding, as you've experienced. How you're sitting there in the dark, you haven't got power. I can't get my water meter read for the last 3 years. And all this plays on us being negative. So we tend to want to steer and take our money overseas. It doesn't mean on fundamentals and valuations, that's the best place to be. Market timing is incredibly wrong. And in conclusion, where I put my money, I would put some of my money in overseas shares like certain tech stocks. I have done that. But of late, I've been bringing my money back into hedge funds. In the last 12 months, I've actually brought money back, believe it or not. And I can, and John T knows this, and I put money into hedge funds, etc., with 1 or 2 well-known fund managers. So my personal money, although I do have money overseas for diversification, I still have holdings in obviously commodities. We still got trillions of rands worth of commodities sitting in South African soil. Those commodities are not going away. We need platinum. We need all these minerals. So South Africa does have a case. We're a niche. We like the Springboks. We pack above our weight in certain areas. Remember, 60% of the Johannesburg Stock Exchange is estimated to be composed of rand hedge shares. So I'm pumping the South African flag here today. I'm just trying to give a different perspective to the audience out there.
Alex, I just want to ask you a quick question because I think as a South African, and I sit on the fence, particularly for today's discussion. But as a South African earning rands, if I go into News 24, I often have a quick look on the right-hand side of the screen and I see what's the rand doing. Is the little arrow up or is it down? Is it green or is it red? Because ultimately I'm earning rands. And, do I want to go overseas on holiday? Do I want to invest money offshore? I'm really affected by the rand. So from a rand perspective, you need to take a view. Is it, 14, 13 rand to the dollar? Is that realistic? Is that where it's going to stay? Is it going to go lower? Is it going to go higher? And that for me is the first fundamental that I'm asking myself, is it priced right? And I think see we've lost Magnus for a while, but I think a person in his position will say, wow, the rand is really cheap at the moment, take your money and run offshore. But the reason I'm raising this is...
Yes and no, because Magnus will come back. He was advocating, and that's where the debate came in. Last year, this time, he was advocating for clients to take their money overseas. And of course, if you read a report from Prudential, the people that took their money overseas have returned. You would have made 42% in dollars, okay, a year ago. Yet in rand terms, investors only received a 10.2% from the same index. So if you'd gone into the MSCI All Country Index, you would have got 42%, but in rands, it only translates to 10.2%. Put another way, John T, if I go and have a look at Naspers shares, Naspers is the biggest listed share in the Johannesburg Stock Exchange. And it's comprised primarily, as you know, of 10 cents. Look at this for an interesting stat. 10 cents is up 15.3% in dollars, in Hong Kong dollars, that is. But if you bring it back into rands, you've lost 8.46% on Naspers. And that's straight off the share price history. So it brings me back to the last point. If we're going back on past performance, Howard and John T, the Johannesburg Stock Exchange over the last 100 years was next to the Australian stock market, the best performer. I'm sure the audience may or may not be aware of that. So if we're going on past performance, the JSE next to the Australian All Ordinaries was one of the best performing stock exchanges, and the American Stock Exchange also slips in there. So that's past performance. If we go into past performance now, we would have gone massively overseas. I agree, we've got to diversify. Asset allocation accounts for about 91% of long-term performance. So you've got to have overseas money. That's not under debate. But what's under debate is right now, are overseas shares overpriced? I would suggest they are. And secondly, you've got no safe haven overseas because bonds and cash in developed markets basically earn you bugger all. And that's putting it in layman's terms. So clients are going to be very prudent. They're going to go into a very expensive equity market overseas, massively stimulated by quantitative easing. So just be aware, there's a risk, there's a sting in the tail. There's a reason like certain guys are hedging and shorting the market right now. But in conclusion, my own personal money is in hedge funds. I do have also short diversification, which is your question, Howard. I do believe that the commodity cycle has got more legs. The minerals are going nowhere. They've got to be dug out of the ground. And in conclusion, I'm a bit like the Springboks. We pack above, we pack above our punch, John C. We won the World Cup. We're not losers in South Africa. We've got some winners here. We must be careful not to down talk ourselves. We live in this country, and if we're all going to be pessimists, then by all means pack our bags and go. But it doesn't mean to say every last cent has to go. And we'll talk about yield separately. I want to talk about pensioners and what their reality is. That's my piece.
Right, we're going to come and unpack that in a second. Magnus, welcome back to us. We always say in South Africa, you can have water, electricity, and internet, but you can't have all three at the same time. At the present moment, we'd maybe be happy with one. But welcome back. Just before you were cut off, we were saying to you, when someone comes and talks to you about diversification, what does that practically mean? Is it anywhere in the world? Are you selecting specific countries? Are you selecting specific industries? Are you telling people to go into big tech, into the Amazons, the Teslas, the Apples? What sort of advice are you giving your clients?
I'll try and summarize a very complex question as briefly as I can. It is, we try and identify global investment themes that are prevalent in the market and ones you can identify. And it's fairly easy to see the themes that are either currently running or building up into future running periods, if I can call it that way. I listened, for instance, this morning to Fidelity, a webinar on global investment themes, and their focus was on climate change, on ESG funds, and of course, technology as a theme, and demographics as a theme. So that's the starting point. Secondly, to answer your question, I will try and find assets or asset classes that you cannot find in South Africa. And I heard the tail end of Alex's statement about the commodities, and we've still got, all the stuff in the ground and that can be dug out. That's great. So if you want your metals and precious minerals, you'll get them in South Africa, but you will not find the Amazons and the Googles and the Facebooks of the world, or the 10 cents, although you can get it through Naspers. You need to look what you can't find in South Africa, and then you're going to find it in another part of the world, healthcare products. And that's been a fairly smart strategy for the last 10 years. And so if you want and you believe that, the technology will continue to play a major role in our lives, despite the high valuations, you cannot completely say, I don't want to invest in technology because the prices might be quite high. They've been high for 10 years and they've delivered fantastic returns. The same with if you want exposure to the Chinese market, you cannot get it through South African stocks. You have to go and externalize some of your assets to get into Chinese stocks or Polish stocks or whatever the case might be. So there are a lot of nuances to that question, but to come back to your original question, I consider myself, and I think the type of clients that we deal with are global investors and global citizens. They tend to travel, they tend to have assets abroad, they send their kids abroad to study, and they come back. It's not always a case of, well, if you don't like it in South Africa, bugger off. I kind of, that's it's an unfortunate smear on someone who recommends offshore investing. I live in South Africa, have no idea plans to leave. My kids are all here. All my grandkids are here. I'm one of the few South African families where we still have all our family in South Africa. But the one way that I would like to make that possible is to have enough offshore assets to protect myself against, one, currency devaluation, secondly, the infrastructural collapse that we're witnessing in South Africa, which you cannot ignore, and thirdly, to protect my international purchasing power in terms of medical treatment, international travel, international holidays and international studies or education. And you can only do that, in my view, if you build a substantial dollar portion into your portfolio, for the reason that the South African market has underperformed for 10 years. The other part of your investment portfolio, which is property, has been a brutal disaster, residential and recently commercial property. So the only way you could protect yourself against that and to diversify is to have some of your money not exposed to the local economic situation, which is undeniable and unfortunate.
So let's just ask you, one of the things that Alex was saying is when he looks at the international markets, particularly things like tech stocks, he thinks they're overvalued. Would you put money into something like an Amazon or a Tesla?
No.
It's first of all, there's, that's what makes markets. You have someone who thinks a market is expensive and will sell, and and another party will think the market is cheap and will buy. That is how markets fluctuate and function since time immemorial. And if you go back over the last 10 years and if you follow the narrative of investment markets, technology stocks, FANG stocks, if I recall, and I follow the media intensely, I mean, every now and then there's someone who gets up and says, the market's going to crash, overvalued, and it keeps on going. And yes, there has been a massive stimulus by the US Federal Reserve. It's something that you have to bear in mind. But there are other parts of the world that is starting to show fantastic growth opportunities. The UK coming out of Brexit and almost winning a soccer game the other day, the stock market is looking good. And parts of Europe are recovering very nicely. Switzerland and the Nordic countries have some exposure to Korea. Japan has been a nice place to park your money. So I'm saying, it's not an all or nothing thing. It depends on what happens in markets, and you have to follow markets. To answer the question, sometimes you've got to believe that the markets will carry on running as long as there are more people buying, but it can change, and you should be alert to that, but it hasn't happened yet. It could be. There are signs that the Fed is changing its strategy, and that could have an impact, but it can also weaken the currency again. So not a simple question, and also not a simple and direct answer.
So just before we ask Alex a question now, Magnus, what percentage of your wealth do you think should be in South Africa, and what percentage should be offshore?
Again, if you, the typical Karoo farmer who says, I want to buy my Toyota Range Rover and I'm buying my sheep and cattle, you'll have 20 to 30%, as opposed to someone who wants to externalize or globalize their future lives, which will be 100%. And then secondly, quite often we get clients, once you show them the volatility that comes with international exposure, they are simply not attuned to that, and you simply do not take money out because their risk profile and their tolerance to risk does not allow for it. You would buy them very high yielding stocks, and that's where the Section 12J issue comes in. South Africa produces fantastic high yields, high returns, which you cannot get anywhere in the world. So you cannot take everybody's money, all of it out. That would be irresponsible to do. If you need the income in South Africa, if you're wanting to match your liabilities with your income, you would be having fantastic income streams in South Africa, priced in rands, with very, very low volatility, and that's still the case. Our yields are very, very high.
Sorry, Jonty, I think I interrupted you.
No worries. Howard, Magnus and to Alex, I was asking Alex, I was getting to the nub of my question a few minutes ago, but really around the rand. So, as many South Africans, we want to take money out of the country, whether it be for leisure, for investment, but timing is obviously critical. And if you took money out of the country 6 months ago and you looked at the rand today, you would have lost a lot of money due to the rand strengthening. So my question to really both of you is, what is the right price for the rand? Is it undervalued? Is it overvalued? And where do you think it'll be, in the next year or two to come, and why?
Can I make a suggestion there, Jonty? If you all, the viewers would have heard of Sir Isaac Newton, probably one of the brightest people that lived on this planet. And he said, I can predict the movement of the planets or the heavenly bodies, as he put it, but not the madness of the crowds. And there's a folly, and I think Magnus will agree with me, since we're making this a lively debate, to predict the future and to predict currencies like trying to predict the weather. Who predicted that the Rand? I don't remember anybody standing up loudly and banging a drum and saying the Rand is going to trade at around 14 at the moment. Everyone thought it was a one-way ticket. And like I said, South Africa is never as bad as we think it is. It's based on fundamentals, supply and demand. And does it hold value? And of course, the commodity cycle has come in. And when the commodity cycle runs, things look a lot rosier. Again, if you take your money overseas, John T, right now, you will not, I can tell you what the yields are right now. 10-year government bond in the US Treasury 10-year bond, 1.63%. And we get 9% in our 10-year government bond. Now, we were talking about junk status, etc. I don't believe Treasury is going to default just yet on those government bonds. So for a pension, remember, we've got a thing called Regulation 28. And many of your viewers out there are pensioners. They've got money tied up in pension, provident funds, etc. Regulation 28 says you can't take more than 30% overseas. Why did they make that regulation? Think about it. Why did they say only 30%? Why not 40% or 50%? I'm sure Magnus will have, I get a bit frustrated with that regulation because obviously someone like you might have a higher risk tolerance level than somebody that doesn't. Like the farmer Magnus said with his bucky in the Free State says, I'm not going to take my money. I'm going to keep my money local. I've got mining clients that will take 100% of their money overseas. I've got clients in living annuities, which are not restricted to Regulation 28. Living annuities, you can put 100% overseas. I've had clients that have 100% overseas. They've got that high risk tolerance level. You know, if you've got 30, 40, 50 million Rand in a living annuity, you can do that. But just one word of warning to the listeners. When you take your money and you put it into the FANG stocks, Facebook, Alphabet, Apple, Netflix, etc., you do you know what the yields are, John? Do you take a guess what the yields are on, and Magnus, you would know this as well. What do you think the yields on those tech stocks are? Take a guess. Anybody of the listeners, anybody want to take a guess what dividend yield you get on tech stock? Let's take Apple, let's take Amazon, let's take Alphabet or Google, and let's take Netflix. Any idea? Let's take Tesla since it's in the debate. What is their dividend yield?
2 to 4%.
I see Herschel Jarvis has guessed 3%. Aubrey Kravitz has suggested 0. If you have a suggestion, please post it in the chat. Arthur Goldstuck says 0.5%. Daniel Kaplan says 0, but that's not the reason you buy. What's the correct answer, Alex?
So how do you live on a 0% dividend? So Magnus would know as well, a lot of our clients are retirees. So if you've got, I'm also the deputy chairman of SAFA, and we tragically lost our chairman, Derek Smorenberg, the other day, but thank God it wasn't COVID, it was a heart attack. And the debate that we had at SAFA, the South African Independent Financial Advisors Association, where our service deputy chairman was, it's the retirement conundrum, the income conundrum. How do you earn a yield if you go and buy a Naspers share or you go and buy a Tesla share or whatever? You're relying on growth. You're relying on the future promise. Remember, Apple almost went bankrupt. Remember, Microsoft, Bill Gates rescued them. Look what happened to our friend Christo Visa with the Steinhoff debacle. Sometimes things look like a sure bet. I want to remind the listeners that you don't make any yields or very little dividend yield. Those other well-informed listeners of yours, you don't make dividend yields on those big stocks. If you go and look at them now, I can quickly read them out to you. At the moment, we're not making anything on Alphabet, no dividend yield. With Naspers, you're making a whopping 0.2%, and 10 cents, you're making 0.28%, etc. The rest of them, Tesla doesn't make a dividend yield. So you're going to have to sell off shares. Okay, once you sold off a share, unit trust, you can't get it back. So your capital is going to depreciate. So you need yield. And right now, South Africa, my task was to bat for South Africa. Doesn't mean I won't put my money overseas or my clients overseas. But I do think that the bond yields are attractive. I do think our interest rates are attractive. And I do think we've been hammered unfairly. Okay, so I think there's a strong case for our high-yielding stocks as well. And we may be less than 0.6% of the world market. But like the Springboks, we do pack above our weight. We've got British American Tobacco, we've got Richmond, we've got some good shares. So if we're restricted with Regulation 28 and we can't put more than 30% overseas, we can still use some of our Rand hedge stocks on the Johannesburg Stock Exchange. We've still got great bond yields. And unlike America, Switzerland, Japan, we make things. And one last quick thing, go and watch again. And John, you'll love this. Do you remember The Big Short? And I remember seeing John Malden, Magnus, I don't know if you know, I'm going to wind up now so you can give a chance. John Malden, you remember, came out here with Paul Stewart about a decade ago. And he warned us, he said, if this subprime crisis starts to hit us, this is when I first heard about it. He warned us about that. And remember, we had a lost decade overseas, Howard, a lost decade. It wasn't until 2008. For 10 years, the American stock market, where did it go? Where did it go? It didn't make money.
John Malden came to South Africa. Well, he came a couple of times, and he was in South Africa 2007.
I remember.
And I listened to him talking about, mortgage-backed securities, and he warned at that stage that the market can come crashing down. Alex, I agree with most of what you say. As I said earlier, South Africa produces fantastic yields. Unfortunately, if you strip out the bond yields and the high income funds, the balance of your funds, whether you're retired or pre-planning, pre-retirement, or a youngster, the equity portion of your portfolio in your Reg 28 funds has not been enough to generate the kind of returns. And so I would disagree on the 30%. I think for young people, there's a very strange situation where a young person, age 30 or 25, is forced by virtue of Reg 28 to have the same risk profile as someone who is 60 or 65.
Sorry,
because you have the.
I said that I would like it to be more than 28%. I said.
I misunderstood you. Sorry about that.
No,
I agree with. So if you have built, Howard asked me the question, where is all my money? Apart from the money in the ashtray and my Ford Ranger Bucky and a couple of properties, it has been offshore. Strangely, partially because of John Malden's views, I started communicating with John Malden. I invited him to come and speak to our clients. He did come and speak to our clients, and I've communicated with him for many years. And he opened my eyes to international diversification. He said I should look at biotech as something, a theme that was running, and I researched it and brought those funds to South Africa. And they've been absolute winners. The point is the JSE, good as it might have been for political reasons and other reasons, is being deserted by the foreign investors. We've had a net outflow of capital to about 550 billion rand in the last 5 years. So money is flowing out of the market, and there's been no the kind of growth that we were used to in the 80s, 90s, and in the early 2000s. That performance has just disappeared from our market for whatever reason. So to get the kind of growth that you want, and I hear your views about the technology stocks, they don't declare dividends. They will tell you, we're not yet to pay dividends. We're not. We reinvest back into the businesses. We will use capital to take over businesses or start businesses. So there are the aristocratic funds, the dividend payers that you can invest in. But yes, if the commodity cycle turns, you can make a lot of money in South Africa. And you did over the last year make very good money. But the last 3 months again, the market has dropped very, very sharply. You've made no money in the last 3 months. But that's my view. To answer your question, Howard, I've built a global investment portfolio based on long-term capital growth. If I needed the income, I will bring it back and I will buy some bonds, and I like the predictability of income. But at the moment, my view is still the same. We need to externalize in some cases, all of it, in order to get growth, depending on your personal situation, depending on your personal assets that you have or might not have in South Africa. Many people, one last word, many South Africans are currently battling because they're property rich but cash poor. And that's something that we can't deny. In the CBD of Joburg, we look at the performance of the listed REITs and the listed property stocks. It's been an absolute bloodbath, which prior to that, for 20 to 30 years, people put money into the Liberty property holdings because of the fantastic dividends. Those have disappeared, and there's been a massive capital loss. So you have to be a little bit smarter with your asset allocation for your clients.
Alex, if you were to select 1 or 2 or 3 shares on the stock exchange that you think offer great value to people, where would your money go?
On the Johannesburg Stock Exchange?
Yeah.
Well, you can't ignore, obviously, everyone's favorite Naspers simply because of the 10-cent holding there. I think that's a pretty obvious one. I do like the diversified conglomerate, for example. Got Bidcorp and Bidvest that broke off. I just like the diversification of the two, the offshore and the onshore options there. And then, yeah, you can't ignore Richemont as a good one. I'm a bit against the smoking, the British American tobaccos, etc. So that would be some of my picks. But for now, obviously, the real favorites, to be blunt, are going to be the platinum group metals. That's where the true story is lying now. So if you're a punter and you like to speculate, you've got to say that the commodities, particularly the platinum group metal shares, are the place to be, or the diversified miners like BHP. I want to make it clear to the listeners, though, I've never been a mining punter of mining shares, and I completely agree with Magnus. I'm totally negative on South African property. Okay, and like Magnus, we have operations, overseas as well. Magnus knows places like Mauritius and the Guernsey places. We also put clients there. The simple debate today is we can't time the market. Timing the market, and Magnus will know the stats, only about 2% of performance over time. By Babich and Brinson, they were Nobel laureates. Everyone's trying to solve this problem. Where do you put your money? There's only one free lunch out there. We all know it. It's diversification. You can't put all your money in shares, and if the shares collapse for 10 years, you're in trouble, right? Fact. You put all your money in bonds, and that doesn't do well, like Zimbabwe, and we have an apocalypse in South Africa, because we think South Africa is going to be, the reason we're having this debate, I can't win the debate based on a future government that's going to go communist on us or rogue. Okay, if that's going to be the case, then obviously I will shift my thinking. I totally agree you must have money overseas, but we are still restricted. We still have exchange control regulations. We still have money stuck in pension funds. And my argument was simply that if we've got money locked in pension funds, which we have regulation 28, and we can't put 30% or more overseas, what do we do? And if your money is stuck in South Africa, where do you hold it? And to me, the bonds and the commodity cycle looks good. Personally, that's, we've got to be careful how we become negative, because at the end of the day, and I am an optimist, I'm a Sagittarian, look at the returns. And the JSE, if you'd got this wrong in the last year, and John T, listen to this. You're a youngster. I've got my youngsters at my office. You made 38% in the JSE the last year. What do you think you made in the MSCI dollar index? Let's have a proper debate here. The MSCI world dollar return, Magnus, do you know how much it was? It was 9.44%. So people that got advice to go overseas a year ago when they were panicking the most, because we humans we react to stimulus. We would have made 38% in the South African stock market and a whopping 9.44 in the MSCI world US dollar. So I'm not advocating, it's impossible to time the market. No one can predict the future. Babich and Brinson said 94% of asset allocation can be attributed, or long-term performance can be attributed to asset allocation. How you invest between bonds, cash, property, and equity. Property, completely agree, it's a disaster in South Africa anyway. Then followed your asset allocation. The next 5% can be attributed to performance roughly to the fund manager you pick. And for me, I like the passive funds. Tracker funds generally do better than active funds. That's a statistical fact. Roughly 70 to 80%, depending on what markets. So if I get 4% of my decision in asset allocation rights, 5% can be attributed to the fund managers. Only 2% comes to market timing. Yet we're all trying to be market timers here. No one can do that. Not even Sir Isaac Newton could get that right, and he was one of the greatest minds. Not even Krista Visa kind of got that right either. People make mistakes. So in conclusion, the other thing you must keep low is costs. Costs that could come to about 2% of performance over time. Overseas funds are expensive. They're expensive. Tracker funds you can run at 0.25% or less. So my takeaway for the viewers tonight are, where I would put my money, as a lover of David Attenborough, I'd put my money into environmental, social, and governance funds. I think that's the future. We've got to have sustainability. Thank you, David Attenborough. ESG funds. I think tracker funds have a place. And I think right now, all bets are off. I wouldn't go and stick 20, 30 million of my money into the world market right now. I would put some of my money into the world market. I don't think, Magnus, this is me personally, Alex Babich, I would not put more than 30 to 40% of my money in the stock market right now. And I can't predict the future. I just don't, I know that my risk tolerance levels wouldn't take it right now. There's too much uncertainty with this COVID. We don't know where it's going. That's my 10 cents worth of information there, Howard.
Magnus, can I ask, someone has posted a question both in the chat and the Q&A section. They said about 2 years ago, you suggested if you had a maturing RA that you should take a living annuity at 17.5% and put all the proceeds in an offshore structure. Is that still your view?
It's been our view for many years. It's been my view for many years that when you reach 55, and again, depending on certain conditions, it makes imminent financial sense to consider with maturing your RA. And yes, I know there are, in some cases, penalties that might kick in, and you have to work out, what the penalties are and whether you want to take the chance. But you might just have straightforward unit trust RAs. It makes financial sense to get your 1/3 cash out of the fund sooner rather than later. That's just a no-brainer. And then convert or remove your 2/3 from the control of Reg 28 and put it into a living annuity where you can then decide on your risk profile how much offshore you want in that case. I did it with my own money 5 years ago. I had money for many, many years with the Blue and the Green insurance company based in the Cape. And I got my 2 and 3% year after year after year. And eventually I pulled the trigger. I converted it into, I took out my cash that I could and put it all into offshore funds 5 years ago. My returns have been 35 to 40% per annum since then. That's me, that's my risk profile. But it makes imminent sense. Why leave your money with probably an investment house with very high costs, as Alex has just referred to? Your cost can be up to 4% in some cases. Take it out. That's not the advice that you will get from these companies, but they cannot argue the arithmetic. Take your cash out sooner rather than later and either pay off your debts or reinvest it. Move it to a platform, and then you can reconstruct a portfolio on very low-cost tracker or index funds, depending on your risk profile. And that we've been doing for years very successfully. The outcomes have been substantially better, and you're in control of your money, and there's no Reg 28 that comes and bites you. Oh, because offshore have done well, you're not going to bring back money. I mean, Alex will know what I'm talking about. It's an absolute nightmare. It doesn't make any sense, the Reg 28, which does not apply after 55. So the outcomes are better. You save in cost, you improve your returns. So my advice to everybody who's got old style
Welcome.
Take the cash out and then start drawing from there, either 2.5% or 10 or whatever your case might be.
Jonty, I have 2 questions left for our panelists. The first question is, where do people get hold of you? Because I think there'll be lots of people today who watching who will want to get hold of both Alex and Magnus to potentially invest with them. So Alex and Magnus, if I could ask you into the chat section, if you could just type in an email address, company name, telephone number, something like that, so people can get hold of you. But the other question that I would love you to answer just in 30 seconds, and Jonty, forgive me for doing this, is cryptocurrency. Do you run a mile or do you embrace something brand new? Alex?
I have publicly stated I'd like to meet someone who can explain fully cryptocurrencies to me. And they've all tried, and I've looked at it, and I've looked at it from many, many angles. And I've said, not for me, thank you very much. Let the next guy buy the cryptocurrencies. And you'll notice how the narrative has gone very quiet. 3 months ago, it was at $50,000 and going to $100,000 and $500,000. And now talk on Bloomberg is it can go to 20,000. I don't fully understand it. It's not a currency to me. It's not an asset class. And there's nothing underpinning cryptocurrency. And I've got some young guys in my office. Aaron, are you listening? Who's a keen Bitcoin buyer, but Aaron was trying to convince me to buy. And I've said, sometimes the old toppies know a little more than the youngsters.
Alex, what's your view on that?
My grandfather escaped communism out of the former Yugoslavia, and he had his sovereign coins, gold coins, in his flight jacket, and he flew King Peter out of exile into Britain. So gold coins are real, and you can put them in your Air Force jacket and fly them out. When it comes to crypto, that's the old school thinking, the gold coins. I happen to have gold coins, but I'm not a big gold coin fundi. I just you get them inherited, etc. Would I buy crypto? I have bought crypto. My son works in the Isle of Man with a techno company, and they do trade crypto, and they do make a lot of money. I don't personally buy it. My son does. He's 27, 28. He's a techno guy, like Magnus's guys. He's sitting in the Guernsey, and that's all they do. They design programs, and they do algorithmic trading and all that. I'm not one of those people. And like Magnus, I also took my money out of my retirement annuity. I took mine out of unit trust-linked funds, and I bought a living annuity, and I have 50% of my assets overseas, and I have 50% locally in hedge funds, because I'm not restricted by Regulation 28. So the truth is, Magnus and I have more in common. It was just to make this debate interesting with the viewers. Obviously, there's a place for overseas, and there's a place for offshore. There's a place for crypto, and there's a place for gold. It depends on your risk appetite. Everybody's a unique individual with unique appetites. And the final point, again, there's only one free lunch, is diversification. So whether you're a risk-averse person or you're a conservative, aggressive person, you will make your decisions. I've been around the block for 27 years. I'm the deputy chairman of SAFA, the South African Independent Financial Advisors Association. Magnus is also a member of our association, and we analyze a lot of fund managers and cryptocurrencies, etc. I think, I don't know if it's real. You know why I don't buy crypto, Howard? I don't like the fact that it's so high energy using it. I don't like it every time Elon Musk makes a comment. You must remember that this has a huge environmental impact, this cryptocurrency, and I don't believe it's sustainable. So from an environmentalist viewpoint, I'm out of crypto. I don't think it's environmentally friendly. It uses too much energy. It doesn't produce anything meaningful. I'll carry on using my Visa card. I call me old-fashioned.
Alex and Magnus, thank you so much for joining us this evening. Please remember just to put your contact details into the chat. We would love people who want to contact you to be able to know exactly how, a website, an email address, a phone number, whatever it is that, however you would like someone to contact you. But thank you, both of you, for joining us this evening. Really appreciate it. It's a fascinating debate. And we're going to go on and talk about, if people are looking for a interesting or tax-free investment, how in fact you can really do it using Section 12J in Jonty, what the last week or last week and a half before Section 12J of the Income Tax Act disappears. But maybe first explain to us, what is Section 12J?
How you won't believe, over the last 7.
Well, sorry, I just muted you by mistake. Sorry, Jonty.
No problem. No, I was just saying, it's amazing over the last 7 years that the same question is asked, and people need to understand how the incentive works. And, you would have thought that such a large majority of us are paying tax that we would have or taken the time to understand it. So what I have done is I've added a couple of slides just to give you a sense of what Section 12J is all about. Let me know if you can see them.
Yep, we can.
And So effectively, Section 12J it's a section of the Income Tax Act. It was introduced in 2009, and really the intention from Treasury's perspective, and really based on similar incentives that's been very successful in the UK and Canada and Australia, is to create funding in South Africa into SMEs. So Treasury decided to introduce Section 12J, which is a tax incentive, and investors are incentivized to invest into Section 12J companies, and the investment they can claim against or reduce their taxable income. So how does it work? The amount that you invest into a Section 12J fund is 100% tax deductible. It's claimed in the tax year that you invest. So if you invest before next week, Wednesday, you can offset your investment against your taxable income ending in February 2022, but you must be in for 5 years. So if you want to enjoy the tax benefit, you must be in for 5 years. If, God forbid, you pass away or you financially immigrate, or due to personal circumstances, you have to exit the Section 12J fund during the 5-year term, well, then you pay back the tax benefit, but without any penalties or interest. So you must be in for 5 years. You must be comfortable with the fact that your money will be locked in. It's illiquid effectively during the 5-year term. And recently, around 2 years ago, it was introduced that there's a limit in terms of how much we can invest per year. So an individual and a trust, they can invest a maximum of 2.5 million a year, and a corporate to a maximum of 5 million. Who should invest? Well, from an individual perspective, if you've got a large income tax event, so maybe you've received a large bonus, or you've sold a property, a share portfolio, or a business, and you've got a capital gains tax event, well then Section 12J is really an effective way to reduce your taxable income. So over the next 2 slides, I'll quickly explain how the numbers work. So if you look at the middle column, maybe you're a taxpayer and you're earning a lot of money, 10 million Rand a year. You decide not to invest in Section 12J, your taxable income will remain at 10 million. On the far right column, we have an individual who's tax savvy. Their taxable income is 10 million. They invest 2.5 million, and you'll see that their taxable income, in other words, the amount on which they'll pay tax, has been reduced now to 7.5 million Rand. So the 2.5 million Rand that is no longer taxable, they've saved in tax in the tune of 1.1 million Rand. So that's it's an enormous saving for an individual. And similarly, if you incurred a large capital gains tax event, so you purchase a property for 10 million, 20 years later you sell it for 50 million, your capital gain is 40 million Rand. In South Africa, of the 40 million, only 40% falls within your taxable income, which is 10 million, and you'll be paying tax effectively on 10 million Rand. So if you invest 2.5 million into a Section 12J fund, it will reduce your taxable income to 7.5, and again, you'll have the same saving as I showed you earlier. So effectively, if you're in the highest tax bracket, the amount that you invest, you can get up to 45% back. If you're in a lower tax bracket, your amount will be lower, and that's very important when we understand the returns that these type of funds generate. So again, for a capital gains taxpayer, if you've sold a property, a share portfolio, or business, Section 12J might be a good solution for you.
So John T, just let us say I earn R1 million a year and I've got the cash flow. I put R1 million into a Section 12J investment. In essence, I pay no tax that year. I have to keep it in. I have to keep it in for 5 years. When I exit that investment after 5 years, though, I pay capital gains tax on the full value, not just the R1 million that I put in and the difference between the then value. Whatever the total value is after 5 years, I pay capital gains tax at that. But effectively, it's a much lower rate than if I had paid 45% tax upfront. Is that correct?
That's 100% correct. And I think this aspect of Section 12J is probably the most misunderstood element. And if I show you the numbers, you'll see that it's very favorable in the investor's hands. So if you invest 100 Rand, if you're in the highest tax bracket, you'll receive as a refund 45 Rand upfront in year one. After 5 years, if you sell your shares and you only get your 100 Rand back, in other words, there's no growth, you'll pay capital gains tax at 18%, which is 18 Rand in the scenario that I'm giving you. So 45 Rand I receive on day one, I pay 18 away 5 years later. So 45 minus 18 gives me 27 Rand or 27%. And that's why people invest into Section 12J funds, because they're getting 27 Rand or 27% from the tax man. Now, if you want to be really technical, what you could do is you could argue that because you receive the 45 Rand on day one, you can invest that 45 Rand. and get a return on it. And that will take your return even higher. But effectively, and investors must understand this really well, is the tax benefit alone, if you're in the highest bracket, is roughly 8%. So when you see a Section 12J fund saying, you know, our returns are 20% or we're targeting 20%, what they're really saying to you is 8% is from SARS and 12% is what we think the underlying investment will yield as a return to the investor. So what's important is all Section 12J funds offer you a really nice tax benefit. They all offer you the same tax benefit. They don't all offer you the same type of returns. And many of those returns are potential returns or targeted returns as opposed to a performance track record.
So Leo, if we can come to you for a second, you've actually done some of those calculations to say, well, if I paid the receive of revenue tax now at say 45% and invested the balance or took that balance overseas, the remaining 55%, and what return would I get as opposed to if I, in fact, didn't pay the tax now, invested the entire amount, 100% in South Africa and paid capital gains tax later? Can you run us through some of those figures?
Sure, I can. Thanks, Howie, and welcome. And good evening to all the listeners. Sure, and it's a nice summary, I suppose, in terms of the discussion you've been having with Magnus and Alex around now. Hang on, what about the Section 12J? How does that impact one's requirement to one's ability to invest offshore? So let me just share a spreadsheet quickly that I have. Can we see that?
Yep.
Great. So really summarizing what John had just said there, for some, essentially the tax benefit is 45%. So just looking at an investor whose marginal tax rate is R1 million, they've got two options. The one is to pay tax of 45%. That's the offshore category, the one on the right, and the one on the left is they're going to invest that locally, that R1 million in, let's call it the marginal R1 million in a Section 12J investment. So ultimately, there's a R1 million investment made in the local side. In the international side, the offshore side, 45% of that money is gone, and they're left with 550,000, which then gets invested offshore. So up front, there's a 450,000 Rand differential, which you've got working for you in the local market. Now, talking about the Rand-dollar exchange rates, I'm not going to try and predict what the Rand-dollar, I'll just tell you, I had to make some assumptions on this. But essentially, if you take our 550,000 Rand and we convert it to the current rate at the moment at 14.30, you'd be left with $38,000. Now, over a 5-year period, the compounding annual growth rate, I've got to grow the numbers at a certain amount. The local investment certainly fairly low risk in terms of many of the 12Js, an 8% compound average growth rate, fairly low in the market in terms of the type of yields you can get. One could get that fairly quickly without too much risk. In my mind, the equivalent amount of risk on an offshore investment is about 3%. You can change it to 4 or 5, whatever it is. But clearly, the offshore side, the yields are lower because of the lower risk-free interest rate. So if you put your money in the bank, what you're getting in an offshore account versus a local account is very different. And then the key number, I suppose, is the annual depreciation of the Rand against the dollar. I've used 5%. I looked at the last 10 years. Over the last 10 years, the Rand has depreciated by 8% against the dollar. But if you took a 20-year view, the Rand has appreciated by 3% against the dollar. So using 5%, and that's probably indicative because of the relative inflation rates of the two different countries, 5% would be an anticipated depreciation of the Rand against the dollar. What that means that in 5 years' time, the Rand should be trading at 18.25. Of course, it could be 15, it could be 25, no one knows. But in terms of a model, 18.25 would seem an expected number. So what happens to our two different investments? The 1 million Rand that we had locally turns into 1.469 million Rand. We do have to pay capital gains tax on that, as you discussed, 18% of the full gain, which is 264, and we're left with 1.2 million Rand. If I convert that back to dollars at the prevailing rate, the 18.25, I'm left with $66,000. On the offshore side, our $44,000 growing at the 3%, it works to $44,000. So you can see quite a significant difference between the 66,000 and the 44,000. Ultimately, the compounding growth rate we're getting is 17% versus the 8.1%. Essentially, where's that coming from? That 9% differential is coming from the 12J benefit. As John T pointed out, you're getting an 8% guaranteed return on your money from the 12J benefit. So here I've basically made the two pretty similar. if you ignore the 12J benefit, you could say that offshore is going to give you a higher than 3% return or 5% return that I spoke about. But either way, it would have to outperform enormously for it to get to an equivalent return that you can currently get because of the 12J benefit.
Thanks, Leo. That's very informative. Really appreciate that. That certainly makes sense to me. Jonty, I trust it makes sense to you. Leo, we're going to come back to you in a few minutes when you're going to be talking about your 12J investment.
Great.
So, Jonty, it would appear that the international markets would have to be astounding in terms of growth, or the rand collapse would have to be enormous in order for you to not invest in a 12J investment in South Africa.
Yeah, absolutely. Howard, I meet with financial advisors and investors on a daily basis, particularly now, given the time of year. And people are saying to me, what do I do? Do I take my money offshore or do I leave it in South Africa? But the answer really is Section 12J is a tax-driven incentive. So if you don't have a tax problem, don't invest into Section 12J. If you do, I think there's a great case to make the investment, particularly if you introduce funding into your investment. With funding, you can gear your investment, take money offshore, still get a 12J investment, and then when you get your refund, you can use your refund to pay off the loan. And I think you'll hear more about that later. But yeah, I think for me personally, I've invested a lot of money into Section 12J because the tax benefit, and if you get some nice yield in the underlying, well, it's a no-brainer.
So the last question before we start hearing from some of our 12J panelists is this a risky investment? I mean, does one look at the underlying investment as one should always and say, how risky is this?
Yeah, so listen, I think investors should ask two questions. The first question is, where is my money actually going to be invested in? Is it going to be invested in to tech businesses, which is much riskier? And there's nothing wrong with risk. It depends on your age, what type of investor you are. Or is it being invested into low risk investments? So it's important for the investor to really have a good understanding of what the underlying investment is. And then secondly, and very, very importantly, is exit. It's great that my money is in a fund that's doing well, but how am I going to get my money out? Because ultimately, if I'm locked in for a long period of time, the tax benefit alone diminishes. So the 8% that I mentioned earlier assumes you're in for 5 years and you exit after 5 years and 1 day. If you're in for 6 years or 7 years because the 12J fund manager is struggling to get your money out, well, then you've got a problem. But then there are also other factors to consider. Does the fund manager have a lot of money that they've struggled to invest in historic years? Because if that is the case, well, you're going to get low returns, especially in the initial period until investment's made. And because it took so long for your money to find a home, you're probably going to be invested for longer because the fund manager wants to generate a yield. Other factors like alignment. Is the fund manager incentivized correctly? So in other words, is there a performance fee at the end? And I think that there should be. And if so, how is that performance fee calculated? Is it on your growth of your investment only, or does it include the tax benefit? If it includes the tax benefit, well, then the investment has to really shoot the lights out in order for you to get a good return because the performance fee is so high. And why I bring that in around risk is because this is all about a return. Now, if there are outside factors that are impacting your return, like fees, like deployment, well, then you are in the wrong fund. And that fund has to really shoot the lights out for you to get a good return. So there are a lot of risks, and investors shouldn't just invest. They should ask these questions. Where's my money going, and be comfortable? And how am I going to get my money out? And if they get comfort with that, well, they're halfway there in determining the risk factor of the fund.
So let's welcome, in fact, our first 12J panelist, and that's Gaurav Nair. Gaurav, welcome.
Thank you. Thank you very much, Harry.
So you have reportedly the best performing 12J fund in the market, the Geltec Infinity Fund. In fact, your business partners is with Jonty.
That's right. That's 100% right.
So tell us about your fund.
So Infinity Anchor Fund, I have a slideshow. Should I go into the slideshow?
Sure, absolutely.
Okay, perfect. Let me share my screen here. If you don't mind, Harry, just telling me if you can see that.
Yep, we can see that now.
Great. Thank you. So Infinity Anchor Fund, we are a fund that invests equity into businesses that have a lot of assets on their balance sheet, and they generate revenue either contractual revenue or fixed regular revenue off of these assets. So the typical type of company is a business that, let's say, rents out assets. That's one way. Or another way is that it generates the cash flows, for example, in a solar company, for example, by selling energy, or one of the businesses we invested into, a fiber company, by internet contracts or purchases of data. And so just picking up on the point that Jonty made earlier about the different type of risk profiles of different funds, by its very nature, Infinity has something that's asset-backed and contractual cash flows in the underlying businesses. Other than reducing the risk profile, this also lends itself to planning an exit. By the time we've been in an investment for 5 years, that business has a lot of assets on the balance sheet, it's asset-rich, and it has a long history of good cash flows. And so this lends itself to a predictable exit. Typically, that business is now very creditworthy and able to borrow money, and that money is used to buy out our assets. buy out our shares, our investment in that business, and we then use that liquidity to repurchase shares from investors, exiting them after the 5-year period. At Infinity, a couple of other points about us. One is we target investing 100% of our capital. This is in contrast to some funds that only target investing 80% of capital. So what this means is that even when fully invested, you still have 20% of your capital just earning interest, and that's kind of a cash drag on the fund, reducing returns for investors. And a final point here is that at Infinity, we charge performance fees on gross capital. So this means that performance fees are only charged on the growth in the total capital that the investors have provided. Again, this is in contrast to some fund managers who charge performance fees on the tax benefit as well, leading to very high performance fees. And that, of course, erodes investors' returns quite aggressively. So a couple of examples of the types of businesses we invest into. These are actual businesses we've invested into. One business which fits the profile of the asset rental type of model is a business called Sackstein. Sackstein is a business that rents out security technology. This is in the form of electric fencing, alarm systems, smart alarms, for example, cameras, and it's usually packaged together to corporates or complexes or apartment buildings, not to individuals. It's packaged together with guarding, armed response, and monitoring. And so this allows Sackstein to charge a premium price on its asset rentals. And Sackstein has performed really well. We've had a track record of 0 bad debts, and that track record has continued even during COVID. It makes sense because I guess security is an absolute necessity, and people would not default on that and have their security equipment taken out. It's been achieving a great return of about 9.7% for us, and that excludes the tax benefit. So that's just what the fund is earning. The tax benefits on top of that for investors. And an interesting point here is that the management team has co-invested 15% of the capital, and that 15% acts as a first loss. So if there's some kind of adverse event, and for some reason the investment size shrinks, it erodes the management's capital first before affecting and protecting Infinity's investors. And that really drives alignment. We don't want management to be more risky with our capital than they have been when running their own businesses. The second business I'd like to talk about is a business called Rise Telecoms. And this is more the long-term contracts model. So what Rise does is they build, own, and operate fiber infrastructure and provide high-speed internet access to clients. Again, very much focused on the commercial tenants. So it is the residential space, but landlords that own apartment blocks, etc., student accommodation, and they are facing a very creditworthy single counterparty. And over here again, this is a model where there's contractual cash flows as opposed to rentals. And the beauty about Rise is that during COVID, of course, saw an explosion of demand. All of us found ourselves at home doing all of our interactions via video, and hence you need high-speed internet or consuming more media via Netflix or whatever else. And so they saw demand go through the roof. The interesting thing is that even as people came out of lockdown and in theory could go back out, they didn't see people canceling their contracts. And I would sometimes joke that, high-speed internet is like drugs. Once you get on, you can't get off it. And that's really been the case. Again, a first loss tranche by the management team. And again, great returns, 9.45% per annum so far. And that's excluding tax benefit to investors. And in fact, Rise has been doing very well and in fact needs more capital. This is due to growth, not because they're distressed. They need more capital to deploy into more assets. And the great thing is that for investors coming in June this year, a good deal of the portfolio has performed well and they need follow-on investments. And so what's great about that is that the new investors will get exposure to these follow-on investments. And it's a bit lower risk because even though we do a thorough due diligence on new investments, the follow-on investments, we know the management team, we know they're honest, they're competent, we understand all the subtleties of the business model. We've seen the growth firsthand and we know it's performing well. So they're a bit lower risk and it's a good deal for new investors coming in. To talk about our actual performance to date, so taking our 2019 investors, for example, our average dividend yield has been about 5.1% per annum. And we've had a consistent track record of paying semi-annual dividends at that number. Now, another measure you often see fund managers in Section 12J space talk about are net dividend yields. This is including the tax benefit, so it's a higher number, it's 9.27%. And the return to investors with everything included. So this is the tax benefit, but also all fees, dividends withholding tax, capital gains tax at the end, etc., is currently tracking 15.35% per annum. And we have 100% of our capital invested for our 2019 investors. So there isn't any cash drag there in that portfolio. And then just to give you an indication of the kind of businesses that are in our pipeline. So one of the businesses that we've completed due diligencing is in the solar space. They're one of the oldest players in solar in the country since 2009, which is really when solar became commercially viable. They're focused on the commercial and industrial area. They don't do residential and they don't do public sector. And they won a tender recently to put solar panels on a large supermarket chain, a blue chip company that everyone would recognize the name. So they needed a facility and we've looking at a 50 million rand facility for them. Again, with a first loss, it's a very important risk mitigation for us. Our expected returns here are 15 to 25%. And the reason for something so high is that there are expected escalations. Still a good deal for the supermarket chain because these escalations are less than what they're expecting to get from Eskom. So still a good deal for them while still giving our investors healthy returns. And the interesting thing is we've signed a term sheet with this business and they're exclusive to us. We're the only Section 12J fund that can fund them. And then just to talk a bit about our financing option.
So sorry, Gaurav, just before you do, let's just talk about or explain to people why that's important, because usually you only invest at the end of February, at the end of the tax year, and you've earned all the revenue or the income for the year. But because Section 12J is closing in 10 days' time or 8 days' time, a lot of people just don't have the cash flow to invest now the full amount that they would want to before the year end, up to 2.5 million rand per individual and 5 million rand per company. So you're saying there's an option whereby you will help people by funding their investment.
That's exactly right, Harry. I couldn't have put it better myself. And a lot of people, exactly that. They might have a good idea of what the earnings for the year is going to be, but either they just made an investment in February or bonuses are later in the year, etc., and they just don't have the cash flow to actually make the investment fully with cash. And so now there's this financing option that we've put in place. So to explain how it works, up front, there's a 5% deposit that investors pay. So to take an example of, let's say, 1 million rand investment, the investor only puts down 50,000 rand. The remaining 950,000 rand is provided by a financial institution. So the investor still gets exposure of a full 1 million rand. And so this enables them to get that full tax deduction. Now, because again, of the timing and being in the middle of the year, if an investor is a PAYE payer, they will only expect to get the tax rebate from SARS in October of 2022. So this is after the tax year ends in February and they submitted their returns, etc. Obviously, a provisional taxpayer gets the benefit sooner. So what we've designed is that the first repayment only happens in October of 2022. And between now and then, the interest rate is fixed at 4% per annum. At that point, the investor should get, in my example, 450,000 rand if they're in the top tax bracket. And they can then use that against the loan, bring the loan to approximately 500,000 rand with accumulated interest. At that point, the interest rate goes up to 9% per annum. and it stays there until February. And then from February onwards, it goes to a floating rate. So instead of being a fixed rate, it goes to a floating rate of prime plus 2. Prime's currently at 7, but at that time it might not be. And that's how the interest then works. The only security that's taken is the actual shares in Infinity, and the dividends paid have to be used against the loan account. The investment, the loan has to be paid off over a period of 4.5 years. So in year 3, 4, and 4.5, there are payments of roughly 200,000 that are paid, which then wipes out the loan. At the end of the period, the investors, of course, gets back the full investment, and the loan balance is totally wiped out.
So, Jonty, is it an unfair question to ask you? Are you putting your money into Infinity this year?
I've put my money into Infinity almost every year. So, what I do every single year is I have a look at what my taxable income is, and then I invest the sum that'll bring my taxable income to 200,000 Rand. I think less than 200,000 Rand, I don't really see the benefit, unless you're going to go over your taxable income, and potentially that can go into an assessed loss. But I'll invest as much as I can in Infinity, as I have in previous years. So absolutely.
So Gaurav, your minimum investment, 100,000 Rand. Maximum for an individual will be 2.5 million, for a company 5 million. We're going to pull up a quick poll because there'll be people who will want you to contact them, and you'll have to contact them urgently because there's only a week left if you want to take advantage of this. But Gaurav, your personal money, is it in Infinity as well?
Yes, yeah, Harry. So my personal money, the money of my family, and that's in fact the case for numerous staff members. Their family is also invested into Infinity. And sometimes I feel like that's the real test. It's interesting that when I invest my money into it, of course, I take care. But when my sister called me and said, I want to invest in Infinity, is it a good idea? At that point, that's the real test. And of course, yeah, she's invested in there too.
Great. It's nice to know that management has skin in the game and their own skin in the game while people are voting. And there's obviously absolutely no obligation. But if you do want more information, or if you do want someone from Geltec to contact you about Infinity, please just answer the poll that we have here, or alternatively on Zoom and YouTube, we're busy, on YouTube and Facebook, we're busy putting in the contact details as well for people to be able to call you. But Gaurav, how much are you hoping to raise in this raise before the end of the month?
So Harry, in fact, the interest has been much bigger than what we usually expect. So if we compare to normal, to kind of in February every year, we raised about 90% of our funding in the last week, which is what we're going into now. Everyone, I guess, leaves everything to the last minute. But this year, we've already raised, the numbers are increasing all the time, but we've already raised, just going to Infinity, it's our only fund that's open, 80 million Rand, and it's not yet the last week. So, our expectation is probably for somewhere around 200 to 300 million Rand. And just the important point that Jonty made about pipeline is, do we have a pipeline, a home for all this money? And currently our pipeline is sitting at almost 400 million Rand. So I think we can comfortably take that amount of money.
Fantastic. So Gaurav, thank you for joining us this evening. Really appreciate it. I see there are close to 40 people on Zoom alone who want you to contact them. Can we get an undertaking that you'll contact people within the next 24 hours? Because I think that is going to be crucial for people to be able to make that investment in time.
Definitely.
Awesome. Thank you so much for joining us this evening.
Thank you, Harry. Thanks.
So Jonty, we've selected, when we were going around, different sort of funds. So people will have access to different sorts of investments. They don't all look the same. They're not all hotels. They're not all asset rentals. And Leo, we had on earlier. And of course, Leo, your fund, which is the Lucid Retirement Fund, is something completely different. You're not into asset rentals at all. You're into retirement properties for individuals. Tell us how that works.
Indeed. Thanks, Howie. Maybe I'll also share my screen and our slideshow.
Lovely looking family.
Thank you. Cool. I don't know why that happened. Cool. So the retirement fund, I mean, a little bit about Lucid to start is that Lucid's been in the 12J space for 5-6 years, and originally in the hotel space, and did numerous investments in the hotel space, and developed their own hotel called Home Suite Hotels, including one hotel in Rosebank, which is rated the top hotel on TripAdvisor in Johannesburg. Corona brought about some challenges in the tourism industry, as everybody knows, and the Lucid Fund is now, the third Lucid Fund is actually a retirement fund. And the good news is I only have to describe one industry and not numerous industries. And why retirement? Interestingly, one of our partners in the fund, that's Cummins & Staples, had been looking at the retirement space probably up to 4 years ago, and very interesting growth in the retirement industry because of the population growth in retirement. The above 60 age category, the largest growing population sector in South Africa. And it's an underserviced sector in South Africa, certainly the high end, large 2 to 3 year waiting lists to get into top end retirement facilities with life rights. And that, I suppose, attracted them to the space, completely excluding 12J. I mean, this was way before they were considering 12J. We were in the hotel space. They were separately looking at retirement, and I think that's quite important because, notwithstanding the fact that on the 30th of June, the end of 12J happens, this retirement fund and this will continue, and we're certainly going to be raising money from private equity investors because it's a very exciting space with large growth opportunities. Just continuing on the retirement space, age in place. It's a bit of a buzzword in the retirement space and it's a move certainly happening overseas, but a move away from retirees having to move from one type of care to another within a facility. So the typical 3 types of care one gets when in an age facility: you get independent living, where you look after yourself completely; you get assisted living, where you get partial assistance; and then you get frail care. And very often in retirement facilities, as one passes through each of these phases, one actually has to move to different places in the facility. Age in place, you buy one location and the care is brought to you at that location. So no need to move. You'll always be in that same location throughout the balance of your life. Technology certainly disrupts most industries, and retirement is no different. Large amounts of opportunities to use technology to enhance the care that's offered to the residents. No time to go into additional detail, but one can, I mean, it's an obvious in terms of the wearables and the cameras, etc., the technology, the communication platforms, all enhance the quality of the care. Jonty spoke about managing risk around when one invests in any investment, I suppose. How does one manage the risk in this investment? Certainly the real estate underpinned. I did see some comments in the chat saying about, well, the 12J was originally was supposed to be a venture capital fund, and people have taken, I suppose, advantage. The truth is, our clients looked for, how do we manage the risk? How do you reduce the risk involved? And investing in property, and property itself is not allowed as an investment. It's the hotel side and the hospitality side that is allowed. So as long as you're defined as a hotel keeper, as we will be as a retirement fund manager, will be a hotel keeper, and the property itself, the real estate that we're investing, acts as an underpin. It has underlying value regardless. The team, it's experienced team, three different groups of companies that have come together to form this fund. Lucid Ventures ourselves, who are the fund managers, and who've been the 12J experts, the financial experts, Cummins & Staples, who I alluded to earlier, then the construction game, been building in Johannesburg for the last 25 years, and then Silveridge, who are our retirement partners. That's Michael Seif and Kareem Briet, who are well known to many of the listeners from their experience at the Chevra Kadisha, managing CEO and COO of the Chevra Kadisha for many years, managing facilities there. So certainly an experienced team in place putting this together. And then pre-sales, another way to manage risk is that before an actual facility is built, we sell a certain percentage of a retirement home. So we know that we'll be able to sell, hopefully sell out the entire facility within a certain space of time. Our budgets allow for a 3-year sellout once the facility is completely built. Just to understand, like a little bit of information, to understand how the cash flows work. It's quite a busy slide, but if I could just try explain this, basically you've got the 12J investors who will put the money into the Lucid Retirement Fund. That then invests in what's called the qualifying company, and you'll have many different qualifying companies underneath the fund. And that qualifying company, we've got 3 specific sites which we already own, which are targeted for development, one in Rosebank, one in Sandton, one in Houghton. That qualifying company then builds. We'll get some bank funding as well to supplement the investor funding, and which enhances returns. But the bank funding then, we use all that money then goes to build the facility. Once the facility is built, we then sell life rights. So we're still the property owner, but we sell life rights in that facility. So retirees come in and buy the life rights, and essentially there we make we budget to make a development profit over the lifetime of the 2 to 3 years, or the 2 years that it takes to develop the property. The retirees pay the money into the life right company, which loans the money back to the qualifying company, and then it flows back to the Lucid Retirement Fund, which then the banks repay their funding, and then that money is then used to develop into the next one. Obviously, it depends on the amount of capital. Realistically, we'll be doing 2 to 3 at the same time, and then as money flows back in from the life rights company, we then move on to the next facility. The model is to certainly build many of these retirement facilities across the country. I'll talk just now about the exit side. So now onto the exit. Where does the money come from in terms of the exit? Well, because we're actually selling these facilities, and we said the life rights get sold as we go along, there is liquidity within the fund to be able to return money to investors after 5 years. So investors can sell their shares back. They can stay on if they want to. This is certainly a long-term investment, and we'll certainly be, our intention is to be in this for many, many years, but the investors have the ability to sell after 5 years. Another option we've given to investors is that they can convert their shares into a life right in one of the facilities, and that just we value both the life right, we value the shares, and then swap them out with a cash payment in the appropriate direction. But a nice add-on so that an investor can go straight for themselves, or their family member can get straight onto a waiting list in one of the facilities. Much like Gaurav, I don't think we as elaborate in terms of the payment mechanisms, but also understanding as how you pointed out around the cash flow implications of the fact that we're not at the end of February now when one's getting tax refunds. But we've given 3 options, basically allowing investors to pay the full amount upfront, 50% upfront, or 25% upfront, with the balance at February 2022, which is in line with what they would have done anyway had this not been a June cutoff period. And we charge a slightly, you'll see instead of 1,010 Rand a share, it's 1,034 and 1,046, a slight increase. It's basically building in a very small interest rate for the fact that the investor is paying slightly late. But in that way, we're managing providing some leverage to investors. And there's just some details. Much like the maximum investment is 2.5 million. That's tax deductible. We are anticipating to raise money post 12J, so it's not only reliant on 12J. So any investor who wanted to invest more, obviously they could, but we wouldn't be able to give a certificate above the 2.5 million. The fee structure is the 2% annual management fee and 20% carry after the gross capital's return. So we're not taking any share of the tax benefit. We'll only charge the 20% once the full capital is actually returned to investors. So it's quite an exciting space. I think we are excited about the retirement industry, and we hope investors will be too.
So Leo, we're going to pull up a poll now for anyone who wants to contact you to talk about this as well. While they do it, if I can just ask you if you could put your contact details into the chat as well. I don't know if Gaurav is still with us, but we've had a number of requests for his contact details too. But Jonty, maybe you can put them in if Gaurav isn't still on the panel with us. But one of the questions, Jonty, that has come in is someone is asking do you have to deploy all of your capital within a Section 12J fund by the end of the month as well, or do you just have to collect the capital and then you still have time to deploy it?
Yeah, well, Section 12J funds have...
And sorry, just while you're answering that, Danny, if I could ask you to pull up the poll for Lucid, please. Thank you so much. And anyone who wants to be in touch with Leo or for Lucid to get in touch with you, please just complete that.
So Section 12J funds have 4 years from the date that they raise the money, technically from the date that they issue shares. So most 12Js will issue shares on the 30th of June. The fund effectively has 4 years if it's a new fund to invest the capital. So there's no obligation on the Section 12J funds to invest all the money by the 1st of July. next week. They have effectively 4 years to invest the capital into businesses. They only need to invest 80% of their money. I would suggest that they should invest all their money, and they need to invest into compliant investments.
Great. Leo, you busy putting your details into the chat section?
So I put it into the chat, not the Q&A, the chat.
Yeah, into the chat section, please. So last question from your side, what is the minimum investment that you will take in your fund?
So, we advertise 1 million, like what we did advertise 1 million, but we can certainly take a small amount. If people want to contact us, we would take low amounts, probably as low as 100,000 Rand, just in line with things. So just make contact with us and we can discuss some appropriate investments. There's certainly, we'll be very flexible.
Great. Leo, thank you so much for joining us. Much appreciated. See you soon.
Thanks.
And with that, let's ask Kit to turn on his video and his microphone, and we're going to watch a very quick 30-second video from Knife Capital before we chat to Kit.
Welcome. Let's go. So Knife Capital, at the heart of it, we invest behind innovation-driven businesses that have some traction. We add knowledge, networks, and funding, and we really focus on exit-centric business building. We have a unique approach to the whole venture capital investment cycle, where we're really focusing on finding good investments, but also finding good investors. There needs to really be a good fit for us all. This is a long journey, and you really need to do it with like-minded individuals with a vested interest in entrepreneurship in South Africa.
So, Kit, tell us about Knife Capital. Where's all your money gone?
Well, in some very exciting companies. I mean, as we were looking at the doom and gloom of keeping your money here or offshore or wherever, I mean, we've invested in numerous scale-up businesses. So we always invest in businesses that have revenue, have traction, have a team, and our expertise is really helping those companies grow internationally. But before I go a little bit into Knife, and I'll be very quick because I know it's late and I really appreciate hundreds of people. I mean, it's an amazing forum. Just quickly wanted to shout out to Jeff Miller. I mean, I know we're at the sunset of 12J, but he was really there at the sunrise and fought the battle in the first couple of years very lonely, and basically changed the industry for the benefit of all. So thanks, Jeff. Thanks for all the advice and mentorship over the years. I really appreciate it. It's a rising tide for all. And secondly, also to John T, very unselfishly shared deal flow and his network, and has really also helped our fund through the years. So thanks, mate. I really appreciate it by the Knife team. So I'm not doing any slides. I did put sort of a downloadable 2-pager teaser doc in the chat. So if anyone wants to have a look at our portfolios and all the rest of it. But just very, very quickly, I mean, I was working in private equity, then at Investec, and then, by some fortuitous events, I started working for Mark Shuttleworth in the venture capital space in 2006-07, where my co-founder Eben and I met each other. We then spun Knife Capital essentially out of Here Dragons and managed that HBD fund for Mark for the first couple of years between 2010 and 2013, 14, 15, while exiting. And really, by some luck, must be said, and some design, we would like to think, I had some fantastic exits in the VC space to the likes of General Electric, Visa, more recently Garmin, Uber. And there's a very exciting exit we're announcing tomorrow, but it's embargoed until 3 p.m. So to another Silicon Valley-based investor. So I think the differentiator is we are a fund that is a little bit more, I guess, on the risky, non-asset underpinned side of things. But, with COVID and the diversification of everyone going online, must also be said, suddenly the crazy people investing in technology-based startups or scale-ups aren't so crazy anymore, So our businesses have software as a service revenue. They grow internationally. They've got dollar-based revenue and rand-based costs, and we help them scale. So what we essentially do very simply is equity-based minority stakes of growth capital into entrepreneurial-based ventures. So we will take a minimum of 10 million rand, maximum of 20% of fund size, which is usually at the moment about 40 million rand or so. Series A type funding, if one knows the terminology of VC, and basically just have a 15, 20, 25, 30% stake of a business and sit on the board, very active management, and help those companies grow towards an exit. Yeah, so liquidity is challenging in our space. How it works in our world is really growing these businesses for dividends, or growing them towards a trade sale to a strategic buyer. And how it really works is we focus very much our incentive structures, our team structures, our skill set around the 4 cycles of venture capital, and that's finding good investors, and that's why we're chatting to some of you good folk tonight. But really, it's very important for us, and that's, I think, why Jonty and us have really worked together over the years to find the right investor for the right fund. You know, there's some fantastic funds here tonight. Really, if I wasn't investing my money in my own fund, I would be enticed to back some of you guys. So really good luck with your fundraise. But you know, it is very important for us. It's a long journey. It's hard. It's a kronkelpaadjie. You know, it's not just one road up, and there's things go wrong like COVID. And it's important for us to have investors that actually care about entrepreneurship in South Africa. You know, we're passionate about it. We really live it. And ultimately, we like to think that our investors are not just in it for the tax break at the 12J second. You know, we've got other VC funds we manage as well, and our own balance sheet as well. But very simply, finding good investors, finding good deal flow, and because of our track record, and because we plugged into the ecosystem for years, we really have some fantastic deal flow. At the moment, we're busy closing 3 transactions actually in legals, another 2 on advanced due diligence, and another 3 in early due diligence. And I mean, it does go through ups and downs, but at the moment, you know, we don't go to bed wondering where the deal flow is going to come from, but it does go in cycles. Then you have to go to make a good transaction. You know, a good business does not equal a good investment. You know, you need to find the right valuation, the right terms, milestone-based investment. Your due diligence processes need to be in place, and basically just make not founder friendly, meaning you can't go in, you know, screwing the entrepreneurs. I mean, you're going to be partners for the next 5 to 7 years. It needs to be a good balance between it, but then the hard work starts in the grow phase. You know, we sit on the boards, we're actively involved, we get to know the people quite well, and ultimately it's about market access. You know, our value proposition is not here's a check, our value proposition is here's a client. And the way we do that, given those clients, is through networks. So, you know, our fund is called KNF, to give you the marketing spiel: knowledge, networks, funding. But we really live that. You know, we feel that the networks are way more important, and I think this forum speaks for itself, than the funding at the end of the day.
I'm going to ask, while you continue, I'm going to ask Danny to stick up the poll, because I'm sure a lot of people would like more information and like you to contact them as well. Can you give us kind of 1 or 2 examples of where in fact you've put your money, practically where you've put your money, and how big is Knife as a business? So we've got, our 12J offering is nearing about 500 million rand. But, you know, we do have also a private equity offering out of a family office in the UK, which is, you know, quite large from a dollar-based perspective. We're raising a $50 million a Series B fund to take these businesses which need to grow even further towards, and there we've got the Mining and Mine Workers Investment Corporation invested with $10 million. We've got the IFC, committed with another 10, and we're still raising that fund, but that's out of Jersey and offshore. So it's a fair chunk of change for this space, but it's ultimately about the exit. And I think just to conclude. So sorry, how much total money under administration by you across all funds? Okay, so the funds we administer, because I'm not going to disclose the family office balance sheet, which I guess confidential, but it's $50 million plus 500 million rand or so, and then plus probably at least double that in on balance sheet family office capital, you know.
And yeah, but so it's fairly small in terms of global VC space, but in South African VC environment, it is very much one of the key players. We've got about 4 or 5 VCs that we really respect and invest with. But yeah, our minimum is a million rand, as the previous speaker. We do for sophisticated investors can make some plans. Our target returns are 30% on the underlying businesses, and as Jonty and everyone explained, plus 8 or 10%, it depend how you target your 12J money and your tax breaks and the capital gains. It's about a 40% net IRR that we target in the hands of the investors. Our previous fund that we totally exited and gave back times money to the investor was a 59% gross IRR and 52% net. We're just humbly trying to get to 30, 40, so that's it's a lot to ask for, but these businesses grow off a low base at that rate. You really don't know what you're doing in the space if you don't invest in businesses that grow 30, 40% year on year. Our fee structures.
Kit, we have to move on to
sure.
Jeff, the doyen of this industry, who's our last speaker for this evening. You said R1 million. People who want to invest with you, invest at Knife Capital, KNIFE, cap.com.
Exactly.
And you'll get back to people almost immediately because time is short.
Look, time is out, so they'll get within the hour. They'll get some feedback from our team. So thanks very much, and good to see everyone, and good luck with the last week of fundraising.
Thanks, Kit. Thanks for joining us this evening. Really appreciate it. So Jeff Miller, welcome from Mdluli, one of my favorite 12J places in the world.
Thanks, Howie. One of mine too.
You haven't gone out on a game drive yet, but you did see elephants at the watering hole in front of the luxury tented safari camp at Mdluli today.
Yeah, they came to visit us today. They welcome all the time.
So this is really your Medina. You were one of the great pioneers of 12J in South Africa. You were talking 12J when no one had a clue what this entire concept was. And now we're at the end. So maybe if you start off by looking back retrospectively, was it a success?
So we were the pioneers of Section 12J, didn't really understand that there was very, very immature legislation, got involved in lobbying government, Treasury, SARS, and for that matter, anyone who would listen. We invited to various commissions, the Davis Tax Commission, and we put some suggestions through to Pravin Gordon, etc., and he listened. And over the years, the legislation has changed numerous times. It has been obviously also amended to close some of the gaps that people were taking advantage of. But I think overall, it's a pity that it's coming to an end. It was always meant to be for 12 years. But, we really, me personally, I thought it would be extended because I thought we were doing a great job in a number of different manners. We were obviously creating funding for SMEs. We were creating jobs. We were, it was private sector investment, keeping money on shore. And unfortunately, we tried hard through the 12J Association of South Africa, which I sit on as a director. But unfortunately, government thought differently, and it's come to an end. But it's been a good road. I think by the end of June, there will be probably about 15 billion of assets invested into this 12J industry. Obviously, not all of it has been deployed to date. But I think it's a good start for alternative investments in South Africa, good start for VCC, and getting people to obviously understand that there's different asset classes that they can invest in.
So Jeff, I want to take just 1 minute to look at a GrowVest video, because you administer so many funds within your portfolio. And then after this video, we're going to come back and talk about 2 or 3 of those funds, because they're also so completely different to the other funds that we've looked at tonight. So Danny, show us the GrowVest video, please. Jeff, so diverse, cannabis growing funds, energy funds, game reserves, hotels in Cape Town. You have the full gamut of absolutely everything. So we're going to talk about a few of the funds, but I want to talk about this fund Meta, because Meta is a fund of fund. If people are confused about which fund to invest in, you've actually gone and done all of the hard work for them, and you've put together a fund of 12J funds. Won't you tell us how that works?
Yeah, sure. So I think it's a novel concept whereby investors can get a diversified portfolio of 12J funds. Obviously, the universe is large. There's probably in excess of 200 Section 12J funds. So a very, very, let's say, an independent investment committee chaired by Adrian Saville has went to the universe and looked at all the various funds that were out there, selected a few funds, and this is in the 5th year of its iteration. And each year, certain funds have been selected for this portfolio. So really, the investor, by investing into Meta, is actually getting a pre-selected, let's say, smorgasbord of funds. It's currently 4 funds across various industries. It's a high income fund that we're offering for this June year end. It's got dividend projections in excess of 6% per annum, and it has achieved these in the last couple of years. It is a large fund. It's got scale, and it's a very, very popular fund amongst investors who want, like I say, diversified portfolio and to diversify risk.
So we're going to pull up a poll now, but as we do that, if anyone wants to contact about the Meta Fund, it's almost a unit trust of other funds, so you don't have to make the hard decisions yourself, do the due diligence yourself. You've already done that. Tell us what's inside the Meta Fund. Which are the 4 funds inside the Meta Fund?
So, as I said, this is a high income fund. It's pretty much low risk. What we've done is that there is some rental of assets. So there's Sunstone Capital in there, which is rental of assets. They have achieved extremely well in somewhere between 6 and 7% dividend yields for the last couple of years. And NAV's net of dividends are still way above the subscription price. And when we're talking dividends, we're talking about on the gross amount, not on the net amount. We have Decentral Energy, which is also a solar fund, which is in corporate industrial, which has also delivered 5% dividend yields over the last couple of years, has just been able to get some gearing of 125 million from the IDC, and has got a large portfolio with as guaranteed income over in 20-year PPAs. There is Gaia, which is agricultural and infrastructure fund, which is obviously also diversified, has got some interesting assets, has done very, very nicely over the last couple of years, also declares dividends. And then we also have another solar fund, also where we can also get reliable, contractual income over the period.
Okay, so that's if you don't want to make all the hard choices yourself, then the Meta Fund is for you. Now, you're sitting at Mdluli at the moment. I want to just show an Mdluli video so people can just understand this amazing property in Kruger Park itself, a luxury tented safari camp with this infinity pool that looks out over the bush. And what makes it so unique is not only is it a 12J investment, but it comes with bed nights as well. So it's a lifestyle investment. You don't just get the underlying investment, you get to actually use it while you're an investor in the fund till what, 2029, is that correct?
Yes, it's a 9-year investment. You get, depending on the package that you buy, is depending whether on how much you invest, is a number of bed nights that you get. But the beauty about this investment, not only do you get the tax benefit on a lifestyle investment, you get your full gross capital back, but also over and above it, you can use those bed nights anytime you want. It's not like timeshare where you're only restricted to a certain amount of time or certain week. And over here, there's no levies, and includes dinner, bed and breakfast and 1 game drive, and you can use it whenever you require. Obviously, subject to availability. So if you book in advance, you're guaranteed to get your reservation.
So, Danny, let's just throw up the video of Mdluli so people understand what we're talking about. It's absolutely magnificent. So, Jeff, what's the minimum investment if you want to go into the Mdluli investment, and how many bed nights do you get with that?
So if you invest into Mdluli, there's 150,000 Rand minimum investment, and you would get 6 bed nights per annum for the 9 years.
Okay,
and then obviously it increases across the, as you invest across the, the different packages.
Okay, that's amazing. And in Meta, what's the minimum investment in Meta?
The minimum investment in Meta is 300,000, and obviously the maximum is 2.5 million for individual and 5 million for company.
Now, I'm going to talk about one or two other funds in a second, but you actually have a 24-hour hotline for people who want to invest in any of the funds that you administer. Because we know time is short, and so someone will be staffing the telephone lines 24 hours a day. Is that the number that you see on your screen at the moment? 011-262-6858.
Yeah, so quite interesting. I think someone alluded to earlier that the demand this year has been far greater than that we've seen in previous years, and we too have seen an abundance of interest and telephone calls and emails. So what we've done is to cope with answering our investors timelessly. We've opened up a 24-hour hotline, info@grovest.co.za, or you can get us on 011-262-6858 until the 30th of June, and we'll be able to assist you and help you with any of our funds. We are currently raising funds for 6 funds that are in the Grovest stable, and so we're there to help. We have seen, like I say, it's been a necessity that so we're there for our investors. A lot of repeat investors. We have a lot of money under AUM, and I think people are taking advantage of the last chance to take advantage of the tax shield.
Well, Jeff, we showed this video of Mdluli, and I want to throw up a poll for Mdluli as well, because it's a lifestyle investment like nothing else that you get in the country. Not only it's a slightly longer investment, it's a 9-year investment, but you get bed nights associated with it. It's a lifestyle as well as a capital investment. And of course, you get the tax refund on it as well. So we've thrown up the poll as well, and we're sticking details relating to the 24-hour hotline that people can call as well, and make an investment in any of the funds that you're involved with. But while people are answering the Mdluli, if they want more information about the Mdluli luxury tented safari camp, Jeff, select one other in your portfolio and tell us about one that you just love.
I think it's very, very hard for me to do that because I love them all. But I think what's important is that we offer a gearing facility in a number of the funds that we offer, whether it's Pepper Club or whether it's Sunstone or Silverleaf or Rensel Solar, where people do not have to lay out the funds now. We have different financing packages. All you have to do is put down 5% before the 30th of June. And then there's a whole lot of different options where one can obviously pay off that Section 12J investment over a period of 5 years, if required in some of the funds. The benefit is that you would be able to get your tax, your tax deduction upfront on the 28th of February 2022. In addition, that if someone's taxable income is below the maximum of 2.5 million, it's advisable, if you can, to take a gearing option of 2.5 million, because you can carry forward The assessed loss or the unused portion to the following year to Feb 23 or Feb 24 if required. And again, on our hotline, we're happy to discuss this with any of the potential investors who would like some more information.
Fantastic.
But going back, Howie, I wanted to talk to you about one of the investments, and I think the one that I have to say, which in my opinion is one that really needs consideration for a whole lot of reasons, and probably because it is risk friendly, is that of the Pepper Club. One is that you have firstly, it's a 5-star hotel in the middle of Cape Town. It's been around for 10 years. Pre-COVID, it was making 30 million rand pre-tax. It is per annum. It's got a guaranteed yield over the 5 years of 7.2%. That means over the 5 years, you're getting 35% of your money back, guaranteed by the promoters. And at the end of 5 years, should you not be happy with your investment for whatever reason, there's a put to the promoters so that you can get your money back. So I think for anyone who's looking to get into a Section 12J, wants to take advantage of the tax benefit and wants to mitigate their risk by having guaranteed yields and having gearing options and having a put option, this is one certainly to consider. We've raised in excess of 500 million for this particular investment. Very well received and very, very popular, and one that I must say that I vote for.
Fantastic. So Jeff, as they say, operators are standing by. The number is 011-262-6858. You can call right now. It's in the chat section as well, and someone will be available to give you information about any of the funds that GrowVest is involved in.
So thank you. And if I can give my 2 cents worth about investing onshore, offshore, I think there's merits for both. But I think that anybody who does not take advantage of the Section 12J first, before taking off the money offshore, has not done the mathematics. Because by investing your first 2.5 million onshore into a Section 12J fund, getting your maximum tax benefit, assuming you're paying tax at the marginal rate of 45%, and then taking any balance offshore is the answer. But you're taking your money offshore without first considering a Section 12J, in my opinion, haven't done the mathematics and is not a savvy investor.
I think Leo proved that point as well when he did it, and I see Denzel said, "Thanks for Meta's answer for me." Denzel, thanks for Meta is the answer for me. Howard, when you said bed nights, I thought you said bed lice. And so I can assure you there may have been a mosquito flying around, but there was absolutely no bed lice at Mdluli at all. You're staying in absolute luxury in an amazing facility. So to the father of 12J on the last week of 12J, Jeff Miller, thank you so much for joining us this evening, and best of luck with your capital raise.
And thank you, Howie. And I just want to thank Kiet for those kind words that he said earlier. And good luck, Kiet.
So, John T, what an evening.
Yeah, very eventful. And Eskom played a very little role in it.
So tell me, give us some words of wisdom in summary at the end. When people are looking at all of these amazing investments that we've looked at this evening, how do you make the decision? What's in your head? Is it about return? Is it about management team? What are the final things that draw you to make that final decision?
Okay, that's very simple. Do you have a tax problem? If the answer is yes, the next question you need to ask yourself is risk. And you need to manage your risk. So if you can take high risk, well then, a tech fund might make sense for you. But if you're at a very senior age in your life, or maybe you've got lots of other risk investments or risky investments in your portfolio, then a risky Section 12 investment might not be for you, and you might want to go for a more asset-backed or property-backed investment because of the lower or potential lower risk. So it's really all risk dependent. And back someone who knows what they're doing when it comes to managing people's money. Track record is essential. So yeah, listen, if all else fails, get a hold of Alex, get a hold of Magnus, and get some advice from a financial advisor. I think that's probably the best advice I can give you.
John T, where are you putting your money this year?
I will be putting all my money into Infinity. I'll go with the gearing option. I think at a 4% interest rate, until October next year, it's a no-brainer. I can get better returns on my cash or higher returns than the 4% on my cash elsewhere. And I'll take the gearing option and I'll decide in October next year whether I'm going to pay off the loan or carry it on for the remaining term. That's where I'm going. Where are you going, Howie?
I'm going to split it amongst a few different places. You know, full disclosure, I'm invested in Infinity together with you. I've invested in Lucid. I've invested with so many people that we've seen this evening and so many others we haven't seen this evening. But I'm a 12J proponent, and I've spread my risk and diversified across multiple places. But you will certainly see some of my investment this year going into Infinity without any doubt.
Brilliant. We look forward to having you.
So to everyone who's joined us this evening, we hope it was interesting. We hope it was informative. A diversity of views, both of investing in South Africa and investing offshore, a diversity of different options for investing in South Africa. And we really just wanted in the last, 7-8 days before 12J closes to give people the opportunity to understand the options that are out there. And the final decision, as always, is yours. But what isn't a decision is the fact that we have to keep the South African Jewish Report running, well-funded. We have to keep it printing. We have to pay our journalists, our editors, our printing, our distribution, our website. It all comes as a cost, and we'd love you to share that burden with us. And therefore, we're asking you to become a patron of the South African Jewish Report. For 23 years, we've been telling your story as a community, bringing you news from the Jewish world, from Israel, from South Africa, bringing information that's relevant to our community. And the 101 webinars that we've done so far have just been an ongoing service to you from the South African Jewish Report. So if you're not yet a patron of our organization or you haven't made a donation to us, tonight is really the opportunity for you to be able to do that. So we play out with a video of our patron campaign. And a final poll for this evening, if you would like someone from the South African Jewish Report to contact you, so you can assist us and become a patron and be part of our family in delivering this remarkable service to the people of South Africa. Please join us as both a donor and a patron of the South African Jewish Report. Good night to all of you. We'll see you again later in the week.